tensions and conflicts are clearly part of the investment process. No business is perfect, and none of the companies that we invest in meet all the criteria that we look for in terms of quality. And we use about a dozen criteria to evaluate business quality, like I mentioned, whether it's the competitive advantage, the recurring revenue or revenue visibility, the margin leverage, the cash flow generation, the returns, et cetera, et cetera. I would say that it's very difficult to find businesses that are pure monopolies, so we end up compromising on that sense. If we do find either natural monopolies or government-sanctioned monopolies, we tend to be aggressive investors in those businesses. But oftentimes the businesses that we own are essentially running a niche within a broader market where they dominate that particular niche, and it may not be big enough for larger competitors yet to step in. So there is that threat of competition. We have a fair number of companies that are duopolists or leading oligopolists. So in that respect, they're not the ideal quality investment. Like you mentioned, management is something that oftentimes we're willing to be flexible on. If they show the vision and they show the execution, but they're not ready yet to return capital to shareholders because they're still in the early growth stages and they would like to reinvest it either internally or through acquisitions in other businesses, then that's something we understand. It's very hard to find companies that are dividend payers or share buyers in the small and micro cap world. So that's something we oftentimes are willing to compromise on, as long as the cash flow generation characteristics and return characteristics are there. That suggests to us that longer term, once they reach a critical mass, they will be able to be more shareholder friendly down the road.